Good morning, Singapore investors. Iggy the Investing Iguana here with your daily dose of SGX market insights. If you're new, welcome to the channel that's racked up over 1 million watch hours, analyzing Singapore REITs, dividend stocks, and global market trends. Today's digest is packed with big moves. DBS just hit a record high, Keppel REIT is pushing into Australian retail, and several companies are making bold capital moves. Let's dive in. Singapore's Straits Times Index climbed 1.14% to close at 4,472 points on October 7th, 2025. The index hit a new 52-week high during the session, marking a strong performance that outpaced many regional peers. Year to date, the STI is up over 25%, driven by banking sector strength and resilient corporate earnings across blue chips. Regional markets showed caution ahead of key U.S. economic data releases, but Singapore's benchmark proved resilient. DBS shares surged 3% to close at $54.80 on Tuesday, pushing the bank's market capitalization past 150 billion Singapore dollars for the first time. The stock touched $54.77 during intraday trading and has now climbed more than 25% year to date. DBS became the first Singapore-listed company to cross the 100 billion US dollar market cap milestone back in June 2025. The bank now commands nearly double the market capitalization of its nearest rival, OCBC. Charu Chanana, chief investment strategist at Saxo, highlighted that DBS offers investors a rare combination of growth, safety, and income. The bank has maintained resilient net interest income despite a softer interest rate environment, and continues to benefit from record fee pools in wealth management and credit cards. DBS has also rewarded shareholders through larger dividends and share buybacks, while maintaining a strong balance sheet. Iggy's take: DBS is the blue chip that keeps on giving. This 150 billion milestone isn't just a number. It reflects investor confidence in Singapore's banking champion. The bank's ability to sustain net interest income in a falling rate environment is impressive. Most banks struggle when rates drop, but DBS has diversified income streams through wealth management and transaction fees. The stock's 25% year-to-date gain might make some investors nervous about chasing at current levels, but quality rarely comes cheap. DBS offers balance sheet strength and consistent cash flow that's hard to find elsewhere. For long-term dividend investors, this remains a core holding despite the premium valuation. Watch for any signs of credit quality deterioration in the next earnings cycle. That's the main risk on the horizon. Keppel Real Estate Investment Trust announced an agreement to acquire 75% interest in Top Ryde City Shopping Centre, a freehold retail mall in Sydney, for 393.8 million Australian dollars or 334.8 million Singapore dollars. This marks the REIT's first pure-play retail asset and signals its strategic expansion beyond Singapore office properties. The acquisition will be completed in partnership with MA Financial Group, which will hold the remaining 25% stake and serve as asset and property manager. Top Ryde City offers 77,054 square meters of lettable area with 2,739 parking spaces and features anchor tenants, including Aldi, Big W, Coles, Kmart, and Woolworths. The mall maintains a 96% occupancy rate with a weighted average lease expiry of 4.2 years. The property is freehold and located on a major arterial route in Sydney, providing strong visibility and access. Keppel REIT will issue approximately 112.5 million new units through a private placement to raise 113 million Singapore dollars to fund part of the acquisition. Units of Keppel REIT closed flat at $1.03 on Tuesday before the manager called for a trading halt on Wednesday morning to announce the deal. Iggy's take: this is a game changer for Keppel REIT. The REIT has been heavily concentrated in Singapore Grade A office space, which can be cyclical and sensitive to economic downturns. Adding Australian retail, especially a convenience-based mall with non-discretionary anchors like supermarkets, brings defensive characteristics to the portfolio. Suburban retail in Australia has proven resilient, supported by population growth and steady consumer spending. The partnership with MA Financial Group is smart. They bring 12.7 billion Australian dollars in assets under management and local retail expertise that Keppel REIT lacks. The acquisition is expected to be DPU accretive, meaning unit holders should see distribution per unit increase. The private placement dilutes existing unit holders by about 10%, but that's reasonable for an asset that diversifies income and improves portfolio stability. Post-acquisition, Keppel REIT's portfolio value jumps to 9.8 billion Singapore dollars with 4.2% retail exposure. This isn't a huge allocation yet, but it signals management's willingness to explore beyond their comfort zone. For investors worried about Singapore office oversupply, this move should ease some concerns. Netlink NBN Trust opened a 110 million Singapore dollar central office in Seletar on Tuesday, marking the 11th central office supporting Singapore's nationwide broadband network. The facility will serve Singapore's northern and northwestern regions, which are expected to undergo significant development in coming years. The new office will provide connectivity to approximately 40,000 new homes across Woodlands North, Woodlands Regional Center, Kranji, Chencharu, and Sembawang North. The Seletar facility will also support major infrastructure projects, including the North-South Corridor and the Johor Bahru-Singapore Rapid Transit System link. Netlink has designed, built, and operated Singapore's fiber network infrastructure since 2008. Units of Netlink NBN Trust closed 0.5% higher at 96 cents on Tuesday before the announcement. Iggy's take: Netlink is the infrastructure play that quietly delivers consistent returns. This $110 million investment in Seletar isn't glamorous, but it's strategic. Singapore's northern regions are being transformed with new housing estates, industrial districts, and major transport links. Netlink is positioning ahead of demand, which is smart capital allocation. The trust operates a monopoly on Singapore's last-mile fiber network, giving it pricing power and predictable cash flows. The 0.5% uptick before the announcement suggests the market wasn't expecting big news, which is typical for Netlink. It's a steady eddy, not a volatility play. For income-focused investors, Netlink offers a defensive profile with modest growth. The trust typically distributes most of its earnings, making it attractive in a low-rate environment. The main risk is regulatory. If authorities cap pricing or mandate infrastructure sharing, margins could compress. But for now, Netlink enjoys a stable operating environment with visible growth drivers in Singapore's northern development. Starhub priced 200 million Singapore dollars in subordinated perpetual securities at 3.35% under its 2 billion multi-currency debt issuance program on Tuesday. The securities will be issued in denominations of $250,000 each, with DBS and UOB appointed as joint lead managers and book runners. The perpetual securities are expected to be issued on or around October 14th, 2025. Net proceeds will be used to finance Starhub's general corporate funding requirements and investments, including potential acquisitions, refinancing existing borrowings, working capital, and capital expenditure. The distribution rate will be subject to a 1% per annum step-up from October 14th, 2032, with subsequent resets every 7 years. Starhub may redeem the securities in whole on October 14th, 2032, or on any subsequent payment date. Starhub shares fell 1 cent or 0.9% to $1.13 on Tuesday. Before the news, Iggy's take: perpetual securities are a clever way for Starhub to raise capital without diluting shareholders. At 3.35%, the coupon is competitive given the current interest rate environment. The $250,000 denomination means this issuance targets institutional and high net worth investors, not retail folks. The key detail here is the general corporate funding and acquisitions language. Starhub's CEO signaled aggressive acquisition plans in August 2025 after the telco posted a 41.7% year-on-year profit decline in the first half of the year. Singapore's telco sector is consolidating, and Starhub needs scale to compete effectively with Singtel. The step-up feature after 7 years is standard. It incentivizes Starhub to refinance or redeem the securities down the road when hopefully their financial position is stronger. The 0.9% share price dip before the announcement suggests investors weren't thrilled, possibly concerned about increased leverage. For Starhub shareholders, the question is whether management can deploy this capital effectively. The telco sector in Singapore is mature and highly competitive. Acquisitions need to make strategic sense and deliver cost synergies. Watch for acquisition announcements in the coming quarters to assess whether this capital raise was justified. Infotech Systems announced on Tuesday that its chief financial officer, Gan Lai Thong, will leave the company on December 31st, 2025, to pursue his own personal interests. Gan, 62, has held the CFO position since May 2021. This comes just 3 months after Infotech made its debut on the Singapore Exchange mainboard in July 2025, marking the first mainboard offering in almost 2 years. The company clarified that Gan's resignation is unrelated to concerns regarding accounting, financial reporting, or internal controls, and that there are no disagreements on any matters impacting financial disclosures. Infotech is currently identifying a suitable replacement and will announce the appointment when confirmed. Shares of Infotech closed 1 cent or 1.1% higher at 89 cents on Tuesday, before the announcement. Iggy's take, CFO departures at newly listed companies always raise eyebrows, even when the official reason is personal interests. Infotech went public just 3 months ago, and typically CFOs stick around for at least a year post-IPO to ensure smooth operations and investor confidence. Gan is 62, so retirement could genuinely be the reason. The company's statement that there are no accounting or internal control concerns is reassuring, but investors should stay vigilant. The real test comes with the next earnings report and when the replacement CFO is announced. If Infotech appoints someone with strong credentials quickly, that's a positive signal. If the search drags on or they promote internally without experience, that's a red flag. For now, the 1.1% share price gain before the announcement suggests the market wasn't worried, but this is definitely something to monitor. Infotech is a software-as-a-service provider in a competitive space. They need strong financial leadership to navigate growth and profitability. Don't panic, but keep this stock on a watch list and reassess after the replacement announcement. A consortium comprising Aspial Corporation and AFGlobal Investment, an entity linked to the Koh family, is proposing to acquire approximately 27.4% or 288.7 million shares in mainboard-listed AFGlobal at 11 cents per share. The total consideration is around 31.8 million Singapore dollars. This excludes the 41.8% stake already owned by Aspial and the 30.9% held by Koh Wee Meng, executive chairman of property developer Fragrance Group and brother of Koh Wee Seng, who helms Aspial. Aspial stated that the privatization will offer greater flexibility to manage AFGlobal and optimize capital resources without the costs and regulatory restrictions of maintaining a Singapore exchange listing. AFGlobal has not tapped equity markets to raise funds since 2010 and is unlikely to do so in the foreseeable future, yet continues to incur listing costs. Shares of Aspial closed flat at 10.3 cents on Tuesday, while AFGlobal shares closed flat at 9.6 cents. Iggy's take. This privatization makes sense from a cost-benefit perspective. AFGlobal hasn't raised equity capital in 15 years, so why maintain a listing and incur compliance costs, audit fees, and regulatory obligations? The Koh family already controls over 70% of AFGlobal, so taking it private gives them full operational control without minority shareholder scrutiny. The offer price of 11 cents per share represents a 14.6% premium over the 9.6 cent closing price, which is modest but typical for privatization deals in Singapore. For minority shareholders of AFGlobal, this is a forced exit at a price that may not fully reflect long-term value, but the lack of liquidity in the stock means few better options exist. The Koh family's empire spans jewelry, finance, property, and hospitality. They've built one of Singapore's largest conglomerates. Bringing AFGlobal private allows them to integrate operations more tightly and redeploy capital without public market pressure. For Aspial shareholders, this transaction is neutral. No major cash outlay since the consortium is funding the acquisition. The key question is whether the Koh family's private empire can generate better returns without the discipline of public markets. History shows mixed results when controlling families take companies private, but given AFGlobal's limited trading and fundraising activity, this move is logical. October 8th, 2025 is shaping up as a dynamic day in the Singapore market. DBS continues its relentless march upward, now commanding a $150 billion valuation that underscores Singapore's banking sector strength. Keppel REIT's expansion into Australian retail shows management ambition and portfolio diversification that should appeal to income investors worried about Singapore office oversupply. Netlink's infrastructure investment in Salida reinforces its monopoly position in Singapore's digital backbone, while Starhub's Perpetual Securities raise capital for potential acquisitions in a consolidating telco sector. The two corporate developments, Infotech's CFO departure and the SBL AFGlobal privatization, highlight different aspects of Singapore's market maturity. Infotech's CFO change warrants monitoring but isn't necessarily alarming, while the AFGlobal privatization reflects rational capital allocation by a controlling family seeking operational efficiency over public market presence. For retail investors, today's digest offers a mix of blue-chip stability, defensive income plays, and corporate actions that reshape portfolio strategies. DBS remains the bedrock holding for dividend growth. Keppel REIT's Australian move diversifies geographic and sector risk. Netlink offers defensive income with infrastructure monopoly characteristics. Starhub is higher risk, but could reward patient investors if acquisitions pay off. Infotech and AFGlobal are niche plays requiring closer scrutiny. As always, the Singapore market rewards investors who dig beyond headlines and understand the strategic rationale behind corporate moves. That's what we do here at Investing Iguana. Break down complex developments into actionable insights. Thanks for reading today's daily SGX Market Digest. Drop a comment below with your thoughts on any of these stocks. And if you're serious about Singapore investing, consider upgrading to our premium newsletter for deeper analysis and portfolio strategies. Stay smart, stay invested, and I'll see you in the next one.